Let me tell you something that most investors get completely wrong. They hear the word growth and they get excited. Their eyes light up. They start dreaming about the next company that is going to multiply their money 10 times, 20 times, maybe even 100 times. And I understand that excitement. I really do. Because there is nothing quite like finding a company early, watching it expand, and seeing your investment compound at extraordinary rates. But here is what 3 decades of managing money has taught me. The pursuit of growth at any price is one of the most dangerous games you can play in financial markets. And right now, in this particular moment, I am shifting heavily toward quality. Not because growth is bad, not because I have lost my appetite for exceptional returns, but because the environment we are operating in demands a different approach. The investors who recognize this shift and position themselves accordingly are going to do very well over the next several years. The ones who keep chasing the high-flying growth names without regard for fundamentals are going to learn some very painful lessons. I have seen this pattern repeat itself multiple times throughout my career. The specific circumstances change, the companies change, the narratives change, but the underlying dynamic remains the same. Investors get seduced by exciting stories and forget about the fundamentals that actually determine long-term returns. And when the music stops, when reality catches up with expectations, the pain is severe. Today, I am going to walk you through exactly why I am making this shift, what I mean by quality, how I identify quality companies, and why the current environment makes this approach particularly compelling. By the end of this discussion, you will have a framework for thinking about your own portfolio that could save you from significant losses and position you for solid returns over the coming years. I want to take you back to a moment that fundamentally changed how I think about quality versus growth. It was 2008. The financial crisis was unfolding in real time. I remember sitting in my office watching screens flash red across every asset class. Banks were failing, credit markets were freezing. It felt like the entire financial system might collapse. The phone was ringing constantly. Clients wanted to know what was happening, what we were doing, whether their money was safe. My team was working around the clock, monitoring positions, assessing risks, trying to stay ahead of a situation that was evolving by the hour. The stress was immense. I had people counting on me, trusting me with their financial futures, and the world seemed to be falling apart. Now, we had positioned ourselves defensively heading into that period because we could see the cracks forming in the subprime mortgage market. We had analyzed the data extensively. We understood that the housing market was a bubble built on unsound lending practices. The loans being made were absurd. People with no income verification, no down payments, adjustable rate mortgages that would reset to unaffordable levels. We knew that when this bubble burst, the consequences would be severe. But even with that preparation, even knowing what was likely coming, the violence of the moves was breathtaking. Correlations went to 1. Everything sold off together regardless of fundamental quality. Liquidity disappeared from markets that had always been liquid. Bid-ask spreads widened to levels that made trading almost impossible. The orderly markets we had always relied upon ceased to function normally. It was genuinely frightening to watch, even for someone who had been anticipating trouble. What I noticed during that period was something that shaped my investment philosophy forever. The companies that survived, the ones that came out the other side stronger, were not the fastest growing companies. They were the highest quality companies. They had strong balance sheets with manageable debt levels and ample cash reserves that allowed them to meet obligations even when credit markets were frozen. They had consistent cash flows from businesses that people needed regardless of economic conditions. Healthcare companies, consumer staples companies, utilities, companies providing essential services that do not go away in a recession. They had products and services that were essential rather than discretionary, meaning demand persisted even when consumers were cutting back dramatically on spending. They had management teams that understood how to navigate uncertainty, that had contingency plans ready to deploy. that could make tough decisions quickly without being paralyzed by fear or indecision. These companies did not just survive the crisis. Many of them thrived. They used the disruption as an opportunity to acquire weaker competitors at distressed prices, picking up valuable assets for pennies on the dollar. They gained market share as less capable rivals retreated to survival mode or failed entirely. They negotiated better terms with suppliers who were desperate for any business. They emerged from the crisis in stronger competitive positions than they had before. It started having used the adversity to improve their businesses. Meanwhile, the growth darlings of the previous cycle, the companies that had been celebrated in magazine covers and television interviews for their rapid expansion and visionary leadership, many of them simply ceased to exist. Their business models required constant access to capital to fund their expansion. They were not generating cash internally. They were burning cash, funding losses with a continuous stream of equity raises and debt issuances. When the credit markets froze, when investors became risk-averse and stopped funding anything speculative, when that capital flow disappeared, so did these companies. I watched investors who had made fortunes on paper in these growth names lose everything. Not 80% of their money, but literally all of it. Not because the underlying ideas were bad. Some of them had genuinely innovative products and services that would eventually be developed by other companies and become important. But because the businesses lacked the durability to survive a genuine stress test, they had grown too fast, funded by too much debt or too many dilutive equity raises, without building the fundamental strength that would allow them to weather adversity. They had optimized for growth at all costs, and the cost turned out to be their survival. That experience taught me something profound about the nature of investing that I carry with me to this day. Survival is the first priority. You cannot compound your wealth if you lose your capital. This sounds obvious when I say it out loud, but it is remarkable how many investors forget this basic truth when markets are rising and opportunities seem abundant. They take on too much risk because risk has been rewarded recently. They concentrate too heavily in speculative positions because those positions have been working. They assume that good times will continue indefinitely because it feels like they will. And then when conditions change, when the cycle inevitably turns, they find themselves in desperate situations with no good options. They have to sell at the worst possible time because they need the cash, or because they cannot stomach the volatility, or because their positions have been forcibly liquidated by margin calls. The companies most likely to help you survive. Difficult periods are not the ones growing fastest. They are the ones with the strongest foundations. Quality is about durability above all else. It is about building positions in businesses that can withstand whatever the economy throws at them. It is about finding companies where the downside is protected, even if the upside is somewhat more modest. This does not mean avoiding growth entirely. That would be a mistake. Some of the highest quality businesses in the world are also growing beautifully. They have found sustainable competitive advantages that allow them to expand profitably, but it means being selective and disciplined. It means demanding that growth comes with strong fundamentals, not instead of them. Let me give you the detailed framework I use to distinguish between genuine quality and the illusion of quality, because there are a lot of companies out there that look solid on the surface, but fall apart when you dig deeper into the numbers and the business dynamics. And there are others that might not grab headlines or get talked about on financial television, but possess exactly the characteristics that create long-term wealth for patient investors. I evaluate quality across 5 dimensions. Each of these matters independently. You cannot ignore any of them and expect to reliably identify truly excellent businesses. First is balance sheet strength. This is the foundation of everything else. A company can have the best product in the world, the most innovative technology, the most charismatic and visionary leadership. But if the balance sheet is weak, if there is too much debt relative to the cash flows available to service it, If liquidity is tight, then that company is vulnerable in ways that can destroy shareholder value overnight. When I analyze a balance sheet, I want to see several things clearly. I want to see manageable debt levels relative to the company's earnings power. I calculate debt to earnings before interest, taxes, depreciation, and amortization as one metric, looking for levels that would allow the company to pay off its debt within a reasonable period, even if earnings decline somewhat. I want to see strong interest coverage ratios that demonstrate the company can easily service its obligations, even if conditions deteriorate. A company that is barely covering its interest payments in good times will be in serious trouble in bad times. I want to see ample liquidity in the form of cash on hand and available credit facilities that can be drawn upon if needed. Companies with tight liquidity can be forced into distressed transactions at exactly the wrong moments. I want to see manageable maturities, meaning the company is not facing a wall of debt coming due in the near term when credit markets might be unfavorable. Companies that have to refinance large amounts of debt during a crisis often cannot do so on acceptable terms. I want to know that when difficult times come, and they always come eventually, this company can survive without needing to raise capital at unfavorable terms that dilute existing shareholders massively or sell assets in distress at prices well below their fair value. Second is return on invested capital. This metric tells you how efficiently a company is using the resources it has. It measures the profit a company generates relative to the total capital that has been invested in the business, both debt and equity capital combined. This is different from return on equity, which can be inflated by simply adding more debt. Return on invested capital tells you about the fundamental economics of the business itself. A business that can generate high returns on the capital it deploys has something special. It has a competitive advantage, some kind of economic moat that allows it to earn more than its cost of capital on an ongoing basis. Maybe that advantage comes from a strong brand that commands premium pricing and customer loyalty. Maybe it comes from proprietary technology protected by patents or trade secrets that competitors cannot legally replicate. Maybe it comes from network effects, where the product becomes more valuable as more people use it, creating a virtuous cycle that new entrants cannot break into. Maybe it comes from economies of scale that allow for lower costs than smaller rivals, enabling either higher margins at comparable prices or comparable margins at lower prices that take market share. Whatever the source of the advantage, companies with consistently high returns on invested capital tend to compound value over time in ways that benefit shareholders enormously. They can reinvest their profits at attractive rates, creating a virtuous cycle of wealth creation. Every dollar they retain and reinvest generates additional returns well above the cost of capital, which can then be reinvested again and again for as long as the competitive advantage persists. This is how truly great businesses create enormous wealth for their shareholders over decades. Third is cash flow consistency. I want businesses that generate real cash, not just accounting profits that show up on an income statement, and I want that cash generation to be predictable and consistent across different economic environments, not dependent on everything going perfectly. There is an important reason I emphasize cash over earnings when evaluating business quality. Accounting earnings can be manipulated in ways that cash flows cannot. Management has significant discretion over many of the estimates and judgments that go into calculating net income. Revenue recognition timing can be accelerated or delayed. Depreciation schedules can be lengthened or shortened. Inventory can be valued using different methods. Reserves can be increased or decreased. All of these involve judgment calls that can make earnings look better or worse than the underlying economic reality of the business. But cash is cash. Either the company is generating it from its operations or it is not. You cannot fake cash flow over extended periods. When I look at cash flow, I want to see consistency over time across different economic conditions. Some businesses are inherently more stable than others in this regard. Their revenues are recurring, coming from subscriptions that renew automatically or long-term contracts that guarantee future payments or repeat purchases of essential products that customers need continuously. Their customers are loyal, with high switching costs that make them unlikely to leave even if a competitor offers a somewhat better deal. The friction of switching is too high, the risk of disruption too significant. Their products are essential rather than discretionary, meaning demand persists even when the economy weakens and consumers are cutting back on unnecessary spending. People stop buying luxury goods in recessions. They do not stop buying food, medicine, electricity, or basic household products. These businesses can plan for the future with confidence. They can invest in growth opportunities knowing the cash will be there to fund them. They can return capital to shareholders through dividends and buybacks consistently. They can maintain their competitive positions without worrying about whether next quarter will be profitable enough to keep the lights on. Fourth is management quality, which is admittedly harder to quantify than the financial metrics I have discussed, but is just as important to long-term outcomes. A company is only as good as the people running it. Even the best business can be destroyed by poor management. And even a mediocre business can be improved significantly by exceptional leaders. I look at track record first and foremost when evaluating management. Has this team created value over time? Not just during bull markets when everything goes up regardless of management quality, but through complete cycles that include downturns and challenges. Have they allocated capital wisely over the years, investing in projects that generate returns above the cost of capital, and avoiding the empire-building acquisitions that destroy value by overpaying for trophy assets? Have they been honest with shareholders about challenges and opportunities, communicating transparently even when the news is bad? Or do they consistently overpromise and underdeliver, always finding excuses for missed targets? Do they think long-term, making decisions that might hurt short-term results, but build sustainable competitive advantages that will pay off for decades? Or are they focused primarily on hitting quarterly targets, managing to Wall Street expectations at the expense of long-term value creation, sacrificing the future to make the present look better? I also look carefully at incentive structures. How is management compensated? Are their interests genuinely aligned with shareholders, or are there conflicts built into their pay packages? Do they own significant stakes in the business themselves, giving them real skin in the game? Are they rewarded for long-term value creation measured over 5 or 10-year periods, or primarily for short-term stock price performance that can be manipulated through financial engineering? Fifth is competitive positioning within the industry. Where does this company sit relative to its rivals? Does it have pricing power, the ability to raise prices without losing significant volume to competitors or substitutes? Can it maintain healthy margins when competition intensifies or input costs rise, passing those costs through to customers? Are there meaningful barriers to entry that protect its market share from new competitors who might want to capture some of those attractive profits? These barriers can take many different forms. They might be regulatory in nature, like licenses or permits or approvals that are difficult and time-consuming to obtain. They might be technological, like patents that provide legal protection or trade secrets and know how that take years to develop. They might be economic, like the massive scale required to compete efficiently in certain industries where fixed costs are high. They might be network-based, where the value of the product increases as more people use it, making it nearly impossible for new entrants to compete against established players. The best quality businesses operate in favorable industry structures, where competition is rational, where participants recognize that price wars destroy value for everyone, and where market leaders can earn attractive returns over long periods without having to constantly fight off aggressive new entrants. Now let me explain in detail why this particular moment in time is especially favorable for quality investing. We are operating in an environment that punishes weakness and rewards strength more than at any time in recent memory. The dynamics have shifted meaningfully from where they were just a few years ago. And understanding these shifts is essential for positioning your portfolio appropriately. Interest rates have normalized after years of artificially low levels for more than a decade following the 2008 financial crisis. Central banks around the world kept rates near zero in an effort to stimulate economic growth and prevent deflation. Then, during the pandemic in 2020, they cut rates again to zero and flooded the system with unprecedented amounts of liquidity through quantitative easing programs. Capital was essentially free for an extended period. Companies could borrow at minimal cost or raise equity from investors desperate for any return above zero. This environment was extraordinarily favorable for growth stocks. When money is free, when there is no cost to capital, you can grow at almost any price. You can raise capital endlessly to fund expansion regardless of whether that expansion is currently profitable, because the present value of distant future profits looks enormous. When you discount them at near zero rates, investors did not care about current earnings or cash flows because future growth was what mattered, and that future growth was being valued very generously. The higher the growth rate a company could show, the more valuable it appeared to be, and because everyone was chasing growth, the stocks of high-growth companies got bid up to extreme valuations, which made them appear to be performing extraordinarily well, which attracted more capital, creating a self-reinforcing cycle that pushed valuations to levels that had no grounding in fundamental value. That world is gone now. Interest rates are no longer zero. They are 5% or higher and may stay elevated for an extended period. Capital has a real cost again. And when capital has a meaningful cost, profitability matters, cash flow generation matters, balance sheet strength matters. All of the fundamental characteristics I have been describing matter more than they did when money was free. Companies that were built on the assumption of perpetual cheap capital are struggling now. Their business models simply do not work when borrowing costs are 5 or 6% instead of zero. They need to generate returns on invested capital above that cost of capital threshold to create any value for shareholders, and many of them cannot. Their growth was funded by investor subsidies, by people giving them money at terms that made no economic sense, not by genuine value creation. Now that the subsidies have stopped, the underlying weakness of these businesses is being exposed. Meanwhile, quality companies with strong fundamentals are thriving in this new environment. They do not need external capital to fund their operations because they generate more than enough cash internally. They can invest in growth opportunities, maintain their competitive positions, and still have substantial excess capital to return to shareholders through dividends and buybacks. Higher interest rates actually help some of these companies directly by increasing the returns they earn on their cash holdings. And the pressure on weaker competitors creates opportunities to gain market share and acquire distressed assets at attractive prices. The economic outlook adds another dimension to this analysis. We have been through a period of extraordinary disruption over the past 5 years that has left significant uncertainty about what comes next. The pandemic shut down large portions of the global economy in ways that had no modern precedent. The recovery that followed was uneven and inflationary, with supply chains breaking down and labor markets tightening dramatically as workers reassessed their priorities. Central banks responded to the resulting inflation with aggressive rate increases not seen in decades, raising the risk of recession. Throughout all of this, economic uncertainty has remained elevated even as some metrics have normalized. The debate continues about whether the economy will achieve a soft landing or eventually slide into recession, whether inflation will prove sticky or continue declining toward targets, whether geopolitical tensions will disrupt trade and investment flows in significant ways. Nobody knows the answers to these questions with certainty, and anyone who claims to is fooling themselves or trying to fool you. In this environment of genuine uncertainty, you want to own businesses that can perform adequately regardless of which scenario unfolds. You want companies where demand is relatively inelastic, where customers need what they sell in good times and bad. You want management teams that have demonstrated the ability to cut costs quickly and protect margins when revenues come under pressure. You want balance sheets that can withstand adversity without requiring emergency measures that destroy shareholder value. Growth companies, by contrast, tend to be more exposed to economic cycles in ways that can be devastating during downturns. Their revenues are often tied to discretionary spending that declines sharply when consumers and businesses tighten their belts. Their cost structures are often heavily fixed, meaning that when revenues decline, margins compress dramatically and losses mount quickly. And because many growth companies are not yet profitable or are only marginally profitable, they may need to raise capital at exactly the wrong time. When markets are fearful, when investors are risk-averse and fleeing to safety, growth companies often cannot access capital on reasonable terms. They either have to sell equity at distressed prices that massively dilute existing shareholders or take on expensive debt with onerous terms that burden the business for years, or in the worst cases, they simply cannot raise the capital they need and fail entirely. I have watched this pattern play out repeatedly through my career. It happened after the technology bubble burst in 2001. It happened during the financial crisis in 2008 and 2009. It happened again in 2022 when rates started rising. Each time, the growth darlings that had been celebrated as the future got crushed, while quality companies held up far better and recovered faster. Valuations in the current market reinforce the case for quality over growth. After the significant pullback in 2022, when growth stocks were hit hard by rising rates, the market rebounded strongly in 2023 and 2024. Some of the mega-cap technology names have performed extraordinarily well, driven by enthusiasm about artificial intelligence and the perception that these companies will be the primary beneficiaries of that technological shift. But if you look beneath the surface of the headline index numbers, you will find that many growth stocks remain extremely expensive relative to their fundamentals. They are priced for perfection, requiring everything to go right every quarter for investors to earn even reasonable returns from current levels. Any disappointment, any sign that growth is slowing or competition intensifying or margins compressing, and these stocks can collapse 20 or 30 or even 50% in short order. The asymmetry is unfavorable. The upside from continued perfection is modest. The downside from any stumble is severe. Quality stocks, on the other hand, are trading at more attractive valuations in many cases, because the market's attention has been elsewhere. The artificial intelligence narrative has sucked all the oxygen out of the room. Investors are focused on identifying AI winners and are ignoring companies that may not benefit directly from that technology, but have excellent fundamental characteristics. This creates opportunity for disciplined investors willing to look beyond the headlines. You can find companies with strong competitive positions, consistent earnings growth, healthy balance sheets, capable management teams, and reasonable valuations. That combination is rare in any market environment, and when you find it, you should act on it. Let me bring together what I have been discussing into a practical framework you can apply to your own investing. Quality and growth are not mutually exclusive categories. In fact, the best investments typically exhibit both characteristics simultaneously. You can find companies that have strong balance sheets, high returns on invested capital, consistent cash flows, excellent management, and sustainable competitive advantages, while also growing revenues and earnings at attractive rates. These are the investments that compound wealth over decades and create financial security for their owners. But when you have to choose, when valuations or risk considerations force you to prioritize one characteristic over the other, quality should come first every single time. Growth without quality is speculation, pure and simple. It might work out brilliantly if everything goes exactly according to the optimistic scenario, but the range of outcomes is extremely wide, and the downside can be devastating. Quality without growth is preservation. Your capital is relatively safe but not working as hard as it could be. Quality with growth is the ideal combination that I am constantly seeking. Start with defense when you construct your portfolio. Before you ask how much you can make on any investment, ask how much you can lose if things go wrong. Every position should pass the sleep test, meaning you would not lie awake at night worrying about it, even in turbulent markets. Focus on businesses you genuinely understand at a fundamental level. Be extremely patient, because the best returns come from compound growth over long periods, not from trading in and out of positions. Ignore the noise that financial media generates constantly, because it exists to capture your attention rather than to help you build wealth. And never stop learning about businesses, industries, and markets, because investing is a lifetime pursuit where knowledge compounds just as surely as returns. Let me give you concrete examples across different sectors of what quality looks like in practice. In healthcare, I prefer the large, diversified pharmaceutical companies with deep pipelines and strong cash flows over the speculative biotechnology names dependent on single clinical trials. In technology, I prefer the established platforms with recurring revenue and network effects over the unproven startups burning cash in pursuit of growth. In consumer goods, I prefer the companies with iconic brands and pricing power over the disruptors, trying to take share through unsustainable discounting. In financials, I prefer the well-capitalized banks with diversified revenue streams over the fintech companies that have never experienced a credit cycle. In industrials, I prefer the companies with leading market positions and essential products over the commodity producers at the mercy of volatile pricing. The common thread is always the same: strong balance sheets, high returns on capital, consistent cash flow generation, capable management, sustainable competitive advantages. These characteristics matter more than growth rates, more than exciting narratives, more than what is popular on financial television or social media. The implementation of a quality-focused strategy requires discipline that most investors lack. You have to be willing to sit out rallies in speculative stocks that seem to be making everyone else rich. You have to accept that your portfolio will sometimes underperform during periods of euphoria when risk is being rewarded indiscriminately. You have to tune out the noise and the fear of missing out and the constant pressure to do something, to trade, to chase performance. This is harder than it sounds because human psychology works against us. We are wired to follow the crowd, to feel pain more acutely than pleasure, to extrapolate recent trends into the indefinite future. But the rewards for maintaining discipline are substantial. Over full market cycles, quality outperforms. Through crashes and recoveries, quality provides smoother returns and less stomach-churning volatility. And most importantly, quality lets you stay in the game long enough for compound growth to work its magic. The opportunity to build positions in high-quality companies at reasonable valuations exists right now for investors willing to look beyond the headlines. The market is obsessed with artificial intelligence and the handful of companies perceived to be winning that race. That obsession has created a two-tier market where some stocks trade at extreme valuations while others, equally excellent in their fundamental characteristics, have been left behind. I am taking advantage of this dispersion. I am building positions in quality companies that the market is ignoring while others chase the hot money trades. This is what disciplined investing looks like. It is not glamorous, it does not generate exciting stories to tell at parties, but it works, and it has always worked, and it will continue to work for as long as markets exist. Quality over growth, strong fundamentals over exciting narratives, durability over speculation. These principles have served me well through bull markets and bear markets, through crises and recoveries, through periods of euphoria and periods of despair. They will serve you well too if you have the patience and discipline to apply them consistently over the long term that wealth creation requires.